Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Brianna Valesky. And we have Scott Redler on the line, Chief Strategist at T3 Live. Scott, how you doing this morning?
Doing pretty good. Been a definitely interesting few sessions. So coming in today, ready to rock and roll and figure out how to maneuver these markets today.
Yeah, I mean, I guess you could either be starting the year off really good or really bad. First, let's just start about, the last day of the trading year. We had that weakness, and did you think it would carry over in the way that did?
It was a little tricky because you never know what's really going on the last two sessions of the year. Some people close their books. Some people start buying some laggards. Some waiting for the first day to sell the strong stocks, and then you also have people who are trying to mark up the strong stocks. So you have like a push-pull relationship that creates some headwinds just for traders themselves, because the usual trends and the usual, I would say, relationships that we trusted all year get a little knocked around in the last week or so of trading. And then the first week or a few sessions, you don't know what new relationships are going to stay the same or change. So it's always good to be a little bit on your toes coming into a new year. And then especially when, if you recall, the last 2 days of the year, the S&P broke that 2079, which was a prior high, creating that false breakout and closing below the 8-day. So in my thesis, and in a lot of my strategies, I talk about if the market loses or the stock loses at the 8 or 21 day, you're no longer an active swing long there. You have to get out of the way and turn more tactical. And if you did that, you're kind of able to get out of the way of what's been, a pretty volatile, weak, risk-off environment for the past few sessions.
Yeah, it certainly has. And you like to sit down at the end of every year and formulate your game plan for the upcoming year. You've been doing it for the last couple of years. Could you just share with us a few of your stocks for your, 2015? And a quick question before you start: do you come out with long and short recommendations, or these are just stocks on your buy list?
Well, I've done that every year. It's a little different because every year we approach a different dynamic. And if you Google Scott Redler predictions for 2012, 13, or 14, you could probably find them all online. And some of those had some really big predictions, where, 2 years ago it was Facebook, 2012, Google was my stock of the year, with Walmart, because a lot of chart patterns were in these long bases last year. It was Microsoft. So there was a lot of awesome things to choose from. So when you get into the fifth or sixth year of a bull market run, it's harder and harder to find the standouts. And unless you want to go against consensus and try and be like the smartest guy in the room, which I don't try and be because I'm not, I just trade the trends of the markets with a common sense system. Each year is different. So we did just come out with our 2015 thesis, and we had a pre-sale on it, and it was delivered last Wednesday, and you can still get it if you go to t3live.com. But I put on there like 10, 11 ideas with some levels and some thoughts and what to look for into the coming year. Just to go over one of them because it's been in play. I listed Twitter as my my social media focus. That it could give outsized gains versus Facebook, which was my focus 2 years ago, and LinkedIn before then. And yesterday it had a big igniting day. Some think it was because there's some talk that, Icon can come in and take a big stake and push for things. But either way, that started the year off pretty well. And now I think just if you're looking at Twitter, it's gapping up today. I'm long some. If you're trading it, maybe you sell some. But I would think that if the move is real, that should hold 38, which would be commitment to yesterday's big move. Today even I think Facebook came out with some WhatsApp news that came in a little harder than I think some would have thought. Maybe you could be a buyer of that versus yesterday's lows. I also talked about oil, because obviously oil has been a big market obsession. And I pretty much stayed away from oil and the oil names all year because another one of my theses is if you're below the 200-day moving average, it's not investable. Below the 8 and 21 day, it shouldn't be in your swing account. Below the 200-day, you shouldn't even have it as an investment. And if you look at oil has been below the 200 days since the summer. The XLEs have been below the 200 days since around the same time. Same for the OIHs. So I figured oil could create some volatility coming into this year, and then at some point within the first, second quarter, there might be enough carnage that we could take advantage of that volatility. So the first target also to buy oil was, I think, listed at like 47.5, and that happened this morning. And now it's actually positive. So I think for today's trade, see if oil stays positive. What I've said with that is a tier system, because, you don't know where a bottom is. But I think that, people wanted my advice on it. And I said, if you didn't buy oil from 90 all the way down, maybe below 47.5, you start tier one, but then give it every $5 to get tier 2 or 3. Because in my mind, my gut's telling me that I don't think we see 20 or the low 30s. I think we see low 40s, and then at some point towards the end of the year, we're back above 55. So, that could be a decent swing trade there. And in the meantime, maybe some opportunities in the actual oil names.
Notice how Scott has, different strict rules that he follows for a day trading long, a swing long, and then also for his portfolio long, and things that, may not get him out of, bad trades, but keeps him up getting into bad trades. I want to know what you base that 47.50 level on as a potential entry point in crude oil.
You go to the chart and go back multiple years. There's a trend line there right around 47 and change. And I just also in my head, when something breaks a round number like a 50, it usually sees 46, 47, and that's a spot where it pauses. If you look at every time oil broke a threshold, it usually stopped around the 6 or 7, tried to bounce back, and when it was a feeble bounce, it was sold further. So, again, it wasn't, a feasibility study combined with a think tank. It was, okay, 47-ish. If I haven't tried it, if any of my guys haven't tried it, maybe you dabble a little bit, but then you don't do it too much too fast, because, again, I don't like to catch a falling knife. But I had to write the thesis because it goes for a year. As a trade, you wait to see a pivot low come in. It bounces off that pivot. You buy versus that pivot, see if it's a real bounce or not, and if it breaks it, you get out. So as a day trader, if you've been trying oil, you could have had some paper cuts because you had levels to trade against. But as a swing trader, sometimes, you have to, or a longer term investor, because that's what this trade would be, you have to just kind of space things out with the system. But 47 wasn't like, again, such a complicated way to come up with the number. I just figured 47.50 isn't starting it so quick below 50, because, you might get a bounce back to 50, and if it fails there, then all of a sudden that 47 gets taken out, and the next level probably comes in the low 40s.
Okay, I want to talk to you about Twitter here. And I was thinking about you yesterday. I was looking at this thing, and I was looking at the 35.50 level. And we had, four consecutive lows in Twitter, I believe, between 35.40 and 35.64, I believe. And I love those kind of formations. But in the back of my head, I said, I'm going to wait for a red dog reversal. And and it never even gained. And I'm like, wow, this thing really has good relative strength. I should buy it. Wow, this thing's really holding up well. And then, of course, the news came up. When you were looking, like, for that level, I mean, obviously you're looking at it longer term. So you don't care if you're buying at 36 and a half, 37, 37 and a half. You obviously have a much bigger target on it. But when you're looking at something and you're eyeballing it for a red dog reversal, and you don't get it, do you set like an upper parameter? Like, I'll just throw an arbitrary number here, like 37.50 out or something like that, where you say, I'm not going to get the red dog reversal, but I got to enter on strength, especially for a day trade.
Yes, and by the way, I try and be pretty precise in my entries also. I'm not so big time where, 50 cents, a dollar 50 doesn't matter. So just to let you know, I like to be precise on the way in and out. So I understand you're waiting and looking for the price. But sometimes, yesterday was a different dynamic because you had the market really, negative and weak, and then all of a sudden Twitter was the first thing to go positive. So I actually traded that from negative to positive. It went up like $1 or so, and then every time it's done that in the past, it kind of failed. So this, for the first time, held steady while the market was still getting pressure, showing you real relative strength. And then I would say, if you kind of drew a line in a trend line from almost remember the day it gapped down on earnings and you had that bottom tail? You can almost draw a trend line from that low all the way down to yesterday, and that broke that trend line. So if you've been shorting every time with that trend line, and you were short, hopefully you were prudent and said, okay, this time it didn't work, I'm out of the way. So shorts cover, which probably they did around 37.10 if they were prudent. And then you also had the moving average of 37.50. So right around there, you had an action area because, breaking the trend line or even that short-term one, short should cover, then breaking that trend line, people looking like yourself to get in, there are buyers there, so then it can go quick. And that creates a good day trade and also gives you, a decent swing trade if you could do that too. So not every trade is going to be the perfect red dog reversal. Plus, shorts use the red dog reversal to get out. So if like a stock like, just say, Apple, let's just quickly turn to that because I'm long that from yesterday. If when you trade through a prior low, that means longs get stopped out, and then the shorts, if they're smart enough, they use that quick move lower to cover their shorts. So they don't have to be the natural buyer. So sometimes a red dog reversal is even a little slower to the upside versus a stock like Twitter that didn't give the shorts a way out by breaking the low. They were like, I'm going to have to cover into strength. So, just say you look at the chart of Apple yesterday. You have actually two red dog reversals, which you can look at if everyone wants to put it up to navigate it. Because if you look at the chart what was that, 1229, you had a red dog reversal when it pushed through 114.52, couldn't hold it and came down. And that's when Apple looked pretty good and the market still looked fine, and that was your sell signal number one. Okay, if you were long from the bottom area from 107, or you got long on the gap up when it broke that descending channel on 1218, all of a sudden, that red dog reversal was a sell signal, or at least, it doesn't have much momentum here. But then the next day, it gave back all of that wide range bar from 1226. So right there, you're like, okay, it's a breakout failure. You have to be careful. And then it broke support around 112, and that was probably the last time I was in Apple. So I was waiting for that red dog reversal yesterday, and it happened right when it went below 105.41, came back above it. You could have bought it there with the stop at the low of the day at 104.63. And now for Apple today, I'm long it. I'm going to see. Hopefully, the gap up isn't the high of the day, which I kind of think it won't be. But if it gets above yesterday's high of 107.43, perhaps that relieves some pressure, and it could see another move towards the 109, 109.60 area.
Using the red dog reversal both on the upside and the downside there, folks. So keep a note. It's not only, you can use it both ways. Do you, and I think I've asked you this before, I mean, you have a stable of stocks, right, that you follow pretty closely and, look for particular setups. Will you ever, like look at this J.C. Penney moving this morning. Will something like that catch your attention? Traded nearly 6 million shares in the pre-market here, trading up $1.50. I mean, is this something like, okay, there's news out, big move, I'm staying out, this is not a stock I trade? Or is this something that, say, whoa, there's going to be some action in this thing today, I'm going to get dirty?
I sometimes go after the news plays, if I'm familiar with it, and even something like J.C. Penney's. I looked at it last night. I was happy to see it because I took some BABA overnight. I figured maybe it'll help some retail. But anyway, I tend to stick to my stable. I don't love trading news plays just because, I don't know much about it, and to me, sometimes I'm not smart enough to know how good the news really is, or if I'm not familiar with the stock, I don't know if it's priced in. But in compelling situations, I'll do it. Like the other day, when Guild was, trading there where the market was getting pressured, and, I followed the bios pretty closely. All of a sudden that news came out. I don't know even know the exact news of, but that them getting listed in insurance as one of their drugs or whatever, and Guild popped up like a buck and change. A lot of my guys went there, and it actually worked. You could have bought it. It wound up closing up 2.5, opened up $1 the next day, and I was a little bit more familiar with Guild versus the situation behind J.C. Penney. So, I do adhere to news, and there are some traders in my office that all they do is trade news because the news is where the volume is. So they at least have liquidity to get in and get out, and then they just use their 3 and 5 minute charts and their gap rules and all of those situations. For me, I tend to have my 20, 30 stocks that do change, and if there happens to be news in one of my stocks, I know my stocks very well, I can actually act on it probably ahead of people, and then have some conviction with it versus just seeing news on a stock that I really don't know nothing about, except for if I do a quick glance at the chart, see whether or not, it's in a weak or really weak or strong or really strong, because, you got to know if good news comes out and the stock just made a huge move over the last month, chances are they might sell it. But if, good news comes out that you think is good news and it's at the bottom of the range, you got to know that it maybe not priced in, and it could have an effect for shorts to squeeze and maybe get a bounce. So that my first indication on JCPenney is everyone was probably short at the yin yang, thinking it's done. So the first move is going to be all the shorts getting squeezed.
Right?
So then you wait maybe an hour or 30 minutes, and if you can't fill that gap, or it can't come in, maybe buy verse that for some kind of continuation, and then you go mop out where resistance 1, 2, and 3 is, where so at least you could have a roadmap of where it could go based on how it follows through for the day.
We're on the line with Scott Redler. He's chief strategist at T3 Live, joining us here on Benzinga's pre-market prep. Scott, just one last question for you here, and I heard you mention, well, I took it home overnight. Now, and I know you're a day trader, and Dennis and I have talked a lot about expanding your time horizon in trading. That you don't always get the instant gratification on a day trade, and you're also competing with the HFTs if you're being too short of a term trader. Do you take things home that generally, are in the green and you think you got more upside on them? Or is it because you're in a trade, you have a defined, risk reward ratio and, or a stop price and you're willing to take a chance on it? Or, so in that case, you would take home something in the red. Just tell us your rules for taking home something overnight.
Well, my rules are all different based on the market environment because, like, just say in the last 4 or 5 sessions, market's been under pressure, so it's been hard to take trades home long as if you don't know if the market's going to go against your thoughts on a stock. So, like, typically I like to be in 7, 8, 9 longs when the market's trending above the 21 day because volatility is down. You're using the market to your advantage instead of just day trading because I started my career just day trading too, and I'm 15 years in. And it takes time to go comfortable from just day trading to, being a swing trader to having something on for multiple days. Turned out, way back in the day, when I was on CNBC every other week, I'd come out with these huge, targets like gold. I said it'd be 1,500 and those at 850. And, I day traded it its way to 1,500 for a sitting. And not saying you sit with them so long, but it turned out that a lot of people are starting to make a lot more money on my longer term projections versus me just actively trading it. So I said, okay, I'm going to hold some in a swing account. So you go, maybe you have 2 accounts. So you have an active account for cash flow, a swing account based on things you want to stay with based on where the market is. So one of my rules is I love to see, stocks in a 3-week, base and it has a day one on volume above that resistance of that base. You day trade it and you take some home for some follow through for a day 2. Sometimes I even stay a day 3. Typically on day 3, I'm out of it. As a swing trade, that's the meat and potatoes of the move. It goes day 4, day 5. I usually look back and I kick myself in the tush and I should have stayed there. But, if you're in there for day 1 through 3, that's a much higher probability thing than sitting around looking for day 4, day 5, day 6, or at least initiating. I'll never buy something on day 4 up and try and stay with that overnight because it's too extended. But so there's different patterns, in different stocks on why you would put a swing trade on. Like Twitter broke that little downtrend on heavy volume, showed relative strength yesterday. So that, to me, was a day trade and a take-home. BABA from 120 down to 100 and change was the first to go green yesterday, showed relative strength, was a good trade. You could probably get some follow-through back to resistance before it makes its mind up around 105 half. So I'm like, you know what? I like this. I'm going to try and stay with that. And the same thing for Apple. Apple came, from 119 all the way down, and then it came from 114 half down to 106. The risk reward of owning it into the reversal yesterday and then maybe it bouncing back to 109, 110 was favorable, also with the S&P holding the 100-day after a 4.5% decline from the highs. So got to kind of put the whole market in perspective and then look at the names you're trading and then look at the patterns and where they're at and figure out what type of, if you want to take it home, and then the next thing is what type of size do you want to take. So,
Excellent. Yeah, excellent explanation, Scott, of your different time frames, your different strategies. Scott Redler, Chief Strategist at T3 Live, joining us here on Benzinga's pre-market prep, probably giving us about 150 trading ideas here off the open in 20 minutes, Scott. Great job. Thanks a lot for coming on, and we're going to get you on again soon.
Sounds good. Have a great day, guys.
Okay, thank you.